morning, happy Friday. Jordan Keck here, your lender buddy with your weekly market update. Starting off, interest rates continuing to move higher due to the Iran oil situation, moving from 6.35% to 6.43% and looking to continue that trend higher. So that moves right into our weekly mortgage tip this week, interest rate locks. If you are not explicitly clear with your current lenders and your clients about locking in interest rates up front, you want to have that conversation sooner than later. The reasoning on this is because if they've got pre-approved when interest rates were at 5.99%, they've gone up nearly 0.5% since that time. That can impact their ability to qualify. It can impact their monthly payments. And if they let their lock float, and they let their interest rate float when you're under contract, that might be 0.5% move from the time you started to the time that you close. Lock the interest rate up front as soon as possible. There's much more to risk by waiting than there is from locking in at this point. So again, my default for all of my clients is to lock in up front. If you're working with a different lender, have that conversation. When is the rate lock done? Is that something the client has to approve? Does the loan officer do it by default? Because you want to make sure that's locked in as soon as possible. Now, are there options potentially for floating down the interest rate if they get better? Maybe there are some options there, but right now there's still much more to risk than there is to gain. Next, the Federal Reserve kept interest rates the same at their meeting, which was as expected, but what changed unfortunately is they squashed virtually all hopes of getting any further rate cuts in 2026. During the press conference after the rate hold announcement, Fed Chair Powell said that inflation was not making the progress they had hoped. Now that's no surprise based on oil that we've been seeing with Iran, but the surprise on this one is Powell specifically cited core goods and non-housing services, which was a surprise to the market. So even if it wasn't for the oil situation, Powell is citing other items that were facing higher inflation amounts, and markets are now pricing in no rate cuts expected in the next 12 months. Next up, also more bad news for it. We have the European Central Bank and the Bank of England both coming out saying that they are considering rate hikes as soon as the end of April. The concern is that the war in Iran pushes inflation higher than their targets had been. And so to try and get ahead of that, they are looking at if we need to push rates higher, try and curb inflation as a result, they are prepared to do that. We also had some more dovish members of the Fed who are more likely to vote for rate cuts that voted not to cut rates, who were previously in favor of cutting, specifically over oil-based inflation concerns. Next, we have a new executive order that's aimed at reducing mortgage regulation. While this isn't actually any change yet, the order directs agencies to reform the way that certain regulations are handled. This includes streamlining TRID rules to prevent delays, modernizing appraisal, which can be looking at reducing barriers to entry, using hybrid and desktop appraisals, and using AI-driven valuation models. There's also a push to make 1 to 4 family construction easier for community banks, pulling it out of the commercial concentration category, which many banks have been reluctant to use for 1 to 4 family, moving more in favor of having those funds for true commercial. Next, we had pending home sales for February rose 1.8% versus an expected decline of 0.6%. This is likely due to rates being in the low 6s or even the high 5s during that time. The number would have been even stronger if it wasn't for bad weather in parts of the Northeast, which was the only region not to see sales grow for the month. Remember, pending home sales are signed contracts for the month. Next, February PPI, which is the Producer Price Index wholesale inflation reports, rose 0.7%, well above the 0.3% that was expected. Year over year, it increased from 2.9 to 3.4%, while the market was expecting it to stay flat at 2.9. This was also before the conflict in Iran and points to potentially larger increases in Producer Price Index wholesale inflation reports in the future. So more bad news for mortgage rates for the week. And lastly here, you might have seen some headlines about this, but the NAR reported that the median age of first-time homebuyers is now 40, but you want to take this with a grain of salt. This is the highest age on record and up from the age of 33 just 5 years earlier, but the New York Fed says that the median home buying age is 36, and Redfin says it's 35, so who is right? Well, it helps to understand a little bit of the methodology of where they're coming up with this number from. So the NAR sends out about 170,000 case surveys each year with only about 6,000 responses to their 120 question survey. Now, out of that, who's going to be more likely to respond to this 120 question survey? Those above 40 or those below? So it's more likely to be considered completed by those above 40, which may skew the data slightly as well. And it's also just a very small sample size. They're looking at 6,000 responses and trying extrapolating that out to a country of over 350 million people. And while the first-time home buyer age has risen, it's more likely close to the 35 or 36 age reported by Redfin and the New York Fed. As always, hopefully this is helpful. Have a fantastic weekend. We'll see you next time. Take care.